Hi friends, welcome back. So we are continuing our series on this classroom Pathshala session, and now we are going to look at a very important risk in the world of fixed income, which is the credit risk. Okay, so we had said the return is comprised of coupon and change in price. Change in price, there are several videos that we have created on that. We have already covered this one. Today we are going to look at coupon. Now, what is a coupon? Suppose, look at the blackboard clearly. Suppose there is a corporate A and there is another corporate B. Both of them are looking to borrow. Okay, both of them are looking to borrow money. Borrow what? Borrow money, and they are looking to borrow for a maturity period of, let's say, 5 years. 5 years for A, 5 years for B. Okay. Now, A ends up borrowing money at a cost, okay, let's say 8%. A is able to borrow money at 8% for 5 years, and B is able to borrow money at 6% for 5 years. All right. So this cost, both of them issue a bond. So A issues a 5-year bond, B issues a 5-year bond, and both of them have a coupon. So these two corporates are borrowing money either at 8 or 6. Now the thing is, why is this company borrowing at 8 when the other person is able to borrow at 6? Okay, so this company is unable to borrow money. So do you think A is happier borrowing money at 8 or B is happier borrowing money at 6? So obviously everybody would like to borrow at a rate lower, right? Everybody wants to borrow money cheaper. So he is borrowing money at 8. This person is unable, or this corporate is unable to borrow money at a rate lower than 8 or anywhere closer to 6 because of existence of risk. Okay, risk. So the investors who have been lending money to A compared to B think that, or they assess that there is higher level of risk in A relative to B, and hence they are looking to be compensated more. They said, okay, I am still all right lending you money, but I don't want to give it to you at 6. I will only lend you money as long as you are giving me little more. And this little more reward that I want for lending money to you is for little extra risk which is there in their company. This risk is called credit risk. What is credit risk? Credit risk is the risk that you are going to carry on your books when you lend money to somebody. Okay, like Government of India. Government of India, do you think the Government of India is going to ever default? There is a remote chance they are going to default ever. So that's the sovereign. So that's the highest level of risk. Okay, highest level of credit worthiness, not risk, higher level of credit worthiness. So GSEC is the highest level of risk. Then comes AAA. Then comes AA plus, AA minus. So these are called credit ratings. Credit ratings. I think we had a short video on this before also. Okay, credit ratings. Now, when as an investor, we are lending money to somebody. Okay, so what am I interested in? I am interested in to figure out that if I lend money to A, while I'm lending money to him at 8% versus B at 6, there is always something which is called probability of default. Correct? There is always a probability. Whether this default happens or not, nobody knows. Somebody is borrowing money at 4%. Does it mean that there is no probability of default? There is always a probability of default. But the probability of default might be low for these corporates compared to this or compared to this, and so on and so forth. Okay. So there is one concept, that is probability of default. We are going to cover extensive videos on that. Then suppose you lend money to some corporate and the default actually happens. The company is unable to. So what is a default? So let me just digress a little and talk about what is a default. So when you are lending money to somebody So let's look at this example. So A has borrowed money at 8% for a period of 5 years. Okay. That means in the first year, 8 rupees has to be paid. Second year, 8 rupees has to be paid. Third year, 8 rupees has to be paid. Fourth year, 8 rupees has to be paid. And then the fifth year, 108 rupees have to be repaid. Okay. Now, when I say the first year, there is actually a date. Like for example, today is 5th of November. So 5th of November 2025. On this date, 8 rupees has to be paid. 5th of November 2026, 8 rupees have to be repaid. 5th of November 2027, 8 rupees has to be repaid. 5th of November 2028, 8 rupees has to be repaid. And in the fifth year, 5th of November 2029, 108 rupees has to be refunded. Okay. Now, so what is a default? What is a default? Okay, what is a default? Default is, so on these interest payment dates, these are called interest payment dates, IP dates, interest payment dates. On these dates, company A is supposed to pay interest to the investor. If there is a delay, okay, there could be a delay of even 1 day. So suppose instead of 5th of November, they said, you know what, we can't pay you on 5th of November, we can pay you on 6th of November. For example, hypothetical situation, but it can happen, right? The company can come back and say, you know what, there is a delay of 1 day. Delay is equal to default. In the world of fixed income investments and bonds, even a 1 day's delay is equivalent to a default. So default can happen on any of these dates, okay, including this one, even on the maturity date. So the default means delay. Delay could be as short as like 1 day as well, is a default, okay. Now let us assume there has been a default, okay. Now, suppose you have lent 100 rupees and there is a default of the company, okay. What does it mean? That means you will now scramble to recover whatever you have lent, but the company hasn't paid you, so you will try and confiscate assets, right? So it could be fixed assets. If this bond is secure, suppose you have lent money against some security. Security could be cash receivables, security could be fixed assets, could be plant and machinery, inventory, anything could be a security, right? So you will calculate something called loss given default. So what is the actual loss that you are incurring in case a default has happened? So this is another credit risk concept that we generally discuss. Probability of default, loss given default, and so on and so forth. There is the third one, which is the credit spread. Okay. So before winding up today's video, I'm going to talk about not the first one, not the second one, but the third one in brief. Okay. So we are discussing credit spreads over here, and we will discuss probability of default and loss given default at some point in time in future. Okay. Now let us look at this company. Company A has borrowed money at 8% for 5 years. Okay. Now, Government of India is suppose borrowing money at 6% for 5 years. Okay. Company A has borrowed money at 8% for 5 years. Government of India has borrowed money at 6% for 5 years. So, what is the credit spread? What is the credit spread? Credit spread is the difference of 8 and 6. So 8% minus 6% is 2%. So the credit spread, so that is the spread additional that I have to offer when I'm borrowing in the market over and above the sovereign yield. So if the government is borrowing at 6, so I'm paying 2. Now how, as an investor, I should be careful? How do I be careful? Suppose when I had lent money, the credit spread was, let's say, 2%. Now, over a period of time, if this 2% is coming down, it is fine. That means the company is able to borrow money at a finer rate relative to government, because government is supreme. If I'm borrowing money 2% higher, I'm somewhere. Tomorrow I'm able to borrow at 1% higher, that means I'm better off. I'm able to borrow 50 basis points higher than sovereign, I'm still better, further better off. But if I am not able to borrow even at 2 and I have to offer 3 or 4 or 5, that means my position is getting worse off. So as an investor, as a fixed income investor, we keep tracking credit spreads of all issuers. Okay, whether it is, doesn't matter whether it's Hindalco, Reliance, ACC, keep tracking the credit spreads. Okay, these are great companies, but there could be other AA plus single companies and so on. Credit spreads keep getting wider or narrower. The movement, the widening of the credit spread is the first indicator that something is not going right in the company, right? So that means what? Why is it that an indicator? Because the company is ending up borrowing money at a cost relatively higher compared to what it had borrowed in the past. All right, super. On that note, we will sign off. Happy investing, and please do follow us, like us, and share your comments. We would love to respond to each one of you. All the best and happy investing.